Hello everyone, and welcome to my video lecture in my Introduction to Business series. And in this video we're going to discuss an area on how we've expanded our businesses from our local areas so that we can generate more profit, and that's with global business. So let's take a look at business from this much more expanded opportunity. You'll hear this term called international business or global business. Now, theoretically, international business is as logical and worthwhile as, say, trade between the state you live in and the state that's in any direction of you, that borders your state. Yet, when it comes to international business, nations tend to restrict the import of certain goods for a variety of reasons. In spite of such restrictions, international trade has increased very steadily since World War II here throughout the 21st century. So in this video, let's look at various different terms and restrictions to international business and all the issues that can be involved in international trade that affect a potential mutual benefit between the business and its customer regardless of borders. International business encompasses all business activities that involve exchanges across national borders. You might ask yourself, well, why do firms want to engage in international trade? Well, the reason that different organizations are going to engage in international trade is for the same reasons they engage within their own domestic trade. And that's to expand their business, and of course what generates everything for the business, and that is profits. When it comes to the basis for international business, we have to talk about absolute and comparative advantage. Absolute advantage is the ability to produce a specific product more efficiently than any other nation. You can think of this example here on the screen. You can see that based off of this chart, the United States can produce more cars per worker for the year than Australia can. Therefore, it has an absolute advantage over Australia in being able to produce cars. That's the specific product that the United States can more efficiently produce than any other nation. Just using this as an example. Now, I also have comparative advantage here. This is the ability to produce a specific product more efficiently than any other product. Goods and services are produced more efficiently when each country specializes in the production for which it has a comparative advantage over the others. You can see here that if we have this chart here, we can produce diamonds at 245 is our base number, and we can say this is in the millions for Africa. But Africa can also produce 22 million parts of corn per year, or we can say bushels when we're talking about corn. Therefore, if we look at, just for comparison, Saudi Arabia, their diamond output is very low. Their corn output is very low, but their oil is very high. Therefore, we can see that when it comes to a comparative advantage, Saudi Arabia should produce oil and Africa should produce diamonds. They have a comparative advantage of the products they can produce. The one that's the highest is what they can produce more efficiently within their country, and that's what they should specialize in their production. Now let's talk about importing and exporting now. I said that when it comes to global business or international business, we need to have some specific terms that we need to understand, and these terms are some of the most important when it comes to global business. Now, importing is simply the purchasing of raw materials or products in other nations and then bringing them into your own country. Exporting is the flipping of that, because exporting is selling and shipping raw materials or products to other nations, which would then become an import to that nation. Canada, Mexico, China, and Japan are the largest U.S. trading partners that we have. The major U.S. exports and imports are manufactured goods, agricultural products, and, of course, mineral fuels. Now, I want to talk about another term, and that's with the balance of trade. This is something you should definitely understand. A nation's balance of trade is the total value of its exports minus the total value of its imports over some given period of time. Now, if a country is going to import more than it exports, its balance of trade is negative, and this is said to be, of course, unfavorable. You would rather make more money than you would spend, common business sense. If you do have this negative deficit, this is what's known as a trade deficit. I'm going to give you an example here to help illustrate this. And to help illustrate this trade deficit, remember, if a country imports more than it exports, its balance of trade is negative, and therefore that's not what we really want, because that's what's known as a trade deficit. So in this representation, we're going to talk about an Ireland and United States trade balancing goods. So in this example, we're going to say that we have $200 billion in exports to the U.S. from Ireland, and then Ireland is importing $600 billion from the United States. Therefore, when we take and find the difference between those, we have a negative deficit or trade deficit here on Ireland because they're spending $400 billion more than they're bringing in, because they're importing so much from the U.S., $400 billion more than what they're making by exporting to the United States. So that's just a rough example, but hopefully I wanted you to understand that a little bit better and understand what trade deficit is. Now, a nation's balance of payments is the total amount or the total flow of money into the country minus the total flow of money out of that country over some period of time. The balance of payments is thus a much broader concept than the balance of trade. And this balance of payments is going to include such things as imports and exports, obviously, a country's investments, money spent by foreign tourists, payments by foreign governments. This is definitely part of that balance of payments. Any aid to foreign governments, because obviously that money is going out, as well as all other receipts and payments during that given period of time. Now, let's look at the different methods of entering international business. And let's just say a firm has decided to enter into international markets, and we can do this in several different ways. Typically, a firm begins its international operations at the very simplest level, and that's with licensing. Licensing is just a contractual agreement in which one firm or organization permits another to produce and market its product and use its brand name in return for a royalty or other type of compensation. Now, the advantage of licensing is that it provides a very simple method of expanding into a foreign market with pretty much no investment, because they're using another organization that's already in that physical location. Now, we also need to talk about another method, and that is with exporting. A firm or organization may also manufacture its products in its home country and then export them for sale into those foreign markets. Now, like licensing that I just mentioned, exporting can be relatively low risk as a method of entering into foreign markets. However, exporting opens up several levels of involvement to the exporting organization and is therefore not a simple method to enter. At the most basic level, the exporting organization may sell its products to an export-import merchant, and really this is just a merchant wholesaler. I wanted to also talk about letter of credit, bill of lading, and draft. These are all important terms to understand when we're discussing exporting to those international markets. Some American companies make products here in the United States and they export those to those foreign markets. And in doing so, a letter of credit is issued by a bank upon request of an importer, stating that the bank will pay an amount of money to a stated exporter. Now, a bill of lading is issued by the transport carrier to the exporter to provide that merchandise has been shipped. And then a draft is going to be issued by the exporter's bank, ordering the importer's bank to pay for that merchandise, thus guaranteeing payment once it's accepted by the importer's bank. The exporting organization may ship its products to an export-import agent, which is going to arrange for the sale of the products of the foreign or to those foreign intermediaries based on some type of commission or fee. Now, an exporting organization may establish sales offices or branches in those foreign countries, and these installations are international extensions of the firm's distribution services or their distribution systems. Another method of entering into international business is that of the joint venture. And the joint venture is simply a partnership that's formed to achieve a specific goal or to operate for a specific period of time. A joint venture may be used to produce and market an existing product in a foreign country or to develop an entirely new product in that country. An advantage of a joint venture would be like a joint venture with an established firm in a foreign country is going to provide immediate market knowledge and access. It's going to reduce risks and it's going to provide control over the product attributes. Now, a disadvantage of a joint venture, one example of that or one disadvantage is that a joint venture agreements are established across national borders, so they can become extremely risky. Another disadvantage is that joint venture agreements generally require a very high level of commitment from all the parties that are involved. Another method would be the totally owned facilities. This is where an organization may develop its own production and marketing facilities in one or several foreign nations. This direct investment provides complete control over its operations, but it carries a greater risk than that with another method like the joint venture. The organization is really establishing a subsidiary in a foreign country. Advantage of using this method is that the direct investment provides complete control over all of the operations. And then disadvantage is that it carries a greater risk than the joint venture. And direct investment may take either one of two forms. The first form is that the firm builds or purchases manufacturing and other facilities in some foreign country and uses these facilities to produce its own established products and then market them in that country. An example of this would be with GM. GM and Colgate, Palmolive have worldwide manufacturing facilities. The other form with this direct investment is where a firm purchases an existing firm in a foreign country under some type of arrangement that allows it to operate independently of the parent company. So an example of this is like when Sony Corporation, and this is out of Japan, decided to enter the motion picture business here in the US. It chose to purchase Columbia Pictures Entertainment Incorporated rather than just start a new motion picture studio from scratch. It bought the facilities that were already existing here. Now we want to talk about yet another method, and that is with strategic alliances. A strategic alliance is a partnership that's formed to create competitive advantage on a worldwide basis. It's similar to a joint venture. Strategic alliances are growing at a rate of about 20% per year across the globe. An example of a joint venture would be with NUMI, or New United Motor Manufacturing Incorporated. With NUMI, this is a strategic alliance between Toyota and GM, or General Motors. And this strategic alliance was formed by these two to combine the quality of engineering of Toyota with the marketing and expertise and the marketing access of GM. This was yet another automobile manufacturing company, and it was based out of Fremont, California, and it was jointly owned between GM and Toyota from 1984 through 2010, where it closed, and then the plant was sold to Tesla Incorporated. Well, now let's talk about trading companies. A trading company is yet another method to enter those other markets, and it provides a link between the buyers and the sellers in different countries. It buys in one country at the lowest price and sells to buyers in another country. A trading company is not involved in the manufacturing or owning assets related to manufacturing. It simply buys products in one country at the lowest price, consistent with the quality, and sells to buyers in some other country. Now we'll talk about counter trade, and this is an international barter transaction in which goods and services are exchanged for other goods and services. An example, and I'll just use Pioneer Seeds here. Pioneer sale of corn to Finland in this example here. They want to have this barter where Pioneer is going to sell corn that is grown here in the U.S. to Finland in return for the steel so they can build storage buildings. Another example is with like Philip Morris and providing a sale of cigarettes to Russia in terms for chemicals that are used to make fertilizers. There are lots of counter trade barters that exist and are going to continue to develop. And then the last method we'll talk about is that of multinational firms. A multinational enterprise or firm is one in which operates on a worldwide scale without ties to any specific nation or region. It is, however, organized under the laws of its home country. In contrast, a large corporation that simply does business in several countries would have tie to its country of origin. Walmart and ExxonMobil are just two examples of some of the largest United States multinational corporations. Now let's talk about those restrictions to international business. Specialization and international trade can result in the efficient production of want-satisfying goods and services on a global basis. Yet the nations of the world continue to erect barriers to free trade opportunities. Now, I'm going to give you a few examples of reasons for those trade restrictions. These trade restriction reasons are going to include such things as to equalize a nation's balance of payments that I mentioned earlier, or maybe to include new or weak industries. Another reason would be to protect national security. Yet another reason would be to protect the health of the citizens in a country. Another reason for imposing some trade restrictions would be to retaliate for another nation's trade restrictions that they've imposed. And then the sixth reason I'll give you for why some countries will create restrictions on trade is to protect domestic jobs in that country. However, the protection of these jobs can be quite expensive. Well, there are three types of trade restrictions that I want to discuss with you right now. The first one is with tariffs. This is perhaps the most commonly applied trade restriction, and that's the customs tariff or an import. You might hear it called a duty, like a customs tariff duty or an import duty. And it's basically just a tax that's levied on a particular foreign product entering into a country. This tax has the effect of raising the price of the product in that importing country. Another one we want to talk about is with the non-tariff barrier. And this is a non-tax measure that's imposed by a government to favor the domestic over the foreign suppliers. These are different types of non-tariff barriers, such as import quotas, embargoes, and currency devaluations. And then we have the cultural barriers. Cultural barriers can impede acceptance of products in foreign countries. When customers are unfamiliar with particular products from another country, their perceptions about the country might affect their attitude toward those products and then help to determine whether they will buy them or not. An example of this is with the colors of black and white. These are colors of mourning in Japan, and thus if you're going to be exporting and entering a market in Japan, you should probably not use black and white as your colors for your packaging, because it just represents mourning in that culture. So if you're going to be working with global business, it's always important to know about the cultures that you're going to be doing business in. Now let's talk about business globalization. Restrictions or not, international business is continuously growing. Globalization is a reality of our time. As trade barriers decrease, new competitors enter the global marketplace, thus creating more choices for consumers as well as new opportunities for job seekers. This increased use of the internet will result in additional growth in our international business ventures. Earlier, I mentioned international trade and World War II. Now, at the end of World War II, the United States and 22 other nations organized the General Agreement on Tariffs and Trade. This is known as GATT. GATT is an international organization of 164 nations dedicated to reducing or eliminating tariffs and other barriers that exist against world trade. GATT sponsored several rounds of negotiations to reduce trade restrictions. Another organization you might have heard of is the World Trade Organization. This is the powerful successor to GATT that incorporates trades in goods, services, and ideas. The World Trade Organization's 164 member nations must observe the GATT rules and resolve any trade disputes under the provisions of the Uruguay Round, which was launched in 1986 to extend trade liberalization and to widen the GATT treaty to include such things as textiles, agricultural products, business services, and, of course, intellectual property rights. I wanted to introduce you to the term of economic communities. An economic community is an organization of nations that are formed to promote the free movement of resources and products among that community's members and to create common economic policies. A number of economic communities now exist, including the European Union, one of the most popular ones ever, the North American Free Trade Agreement, and you've probably heard that term before because you've probably heard it called by its acronym, that's NAFTA. And NAFTA joined the United States with its first and second largest trading partners, that would be Canada and Mexico. Another of these economic communities would be an example of the Central Free Trade Agreement, the Association of Southeast Asian Nations, the Commonwealth of Independent States Trans-Pacific Partnership, known as TPP. You might have even heard of the Common Market of the CONE, or even another one would be like the Organization of Petroleum Exporting Countries. So there are a lot of different communities out there, and this representation of the ones I just mentioned are just a few of the different economic communities that currently exist. Well, when it comes to doing international business, one of the biggest things that we face is with the financing. International trade compounds the concerns of financial managers. Currency exchange rates, foreign exchange controls, tax structures of host nations, tariffs, all of these things affect international operations and the flow of cash. In addition, financial managers must be concerned both with the financing of their international operations and with the means available to their customers to finance purchases. Fortunately, a number of banks, along with businesses in general, have become international in scope. And the first one we'll talk about is the United States Small Business Administration. The USSBA provides up to $5 million in short-term loans to U.S. small business exporters. The Export-Import Bank of the United States, or more commonly termed as Ex-Im Bank, is an independent agency of the U.S. government whose function is to assist in financing the exports of American firms' products. Ex-Im Bank also cooperates with commercial banks in helping American exporters offer credit to overseas customers. And then the Multilateral Development Bank, or MDB, is an internationally supported bank that provides loans to developing countries to help those developing countries grow. The most familiar of these is the World Bank, and this operates obviously worldwide. And lastly, the International Monetary Fund, or IMF. This is an international bank that makes short-term loans to nations experiencing, those negative balance of payment deficits. This financing is contributed by its 189 member nations, and it must be repaid with interest. Loans through this are going to be provided primarily to fund international trade. I know this is a lot of information to process, but throughout this lesson, I provided an overview of what global or international business is, as well as the issues that are involved in national or international trade. The challenges of the 21st century is to build on common bonds and shared values to help fully integrate the United States, Europe, and other established economies with a new group of rapidly emerging economies like China, India, and Brazil, as well as many others. There's a lot into not only understanding what global business is, but how to enter those markets and the different opportunities that exist, as well as financing. Well, thank you for following along in this video. I hope you found the information helpful and are inspired to go out and do some more research into the different areas of global or international business. Thank you, everyone. Take care.